Hello and welcome to RVA Wealth Management's third quarter market update. We appreciate you taking some time to find out what's going on in the markets and what we've been doing as far as the portfolio management is concerned. So the economy this year has remained very resilient despite the increase in interest rates and in spite of inflation. So it's really held its head up. A lot of it does have to do with the job market has continued to be robust. Homeowners and businesses are still benefiting also from low interest rates that they locked in before and during the COVID-19 pandemic. So that does have a lot to do with the continued strength of the economy. Now, there are some signs that things are slowing down, but very slowly. And so we remain very, cautiously optimistic about a soft landing and no recession this year. Barring any unforeseen geopolitical issues, we believe that we will see a positive end to the markets for 2023. We started out with a very narrow tech rally as expanding into other sectors as the Fed has begun to show signs of easing up on their rate action. So early in the year was all about the tech sector, and then slowly we've begun to see other sectors begin to improve as the year has gone on. Technology stocks now do seem elevated in their valuations, but we are also seeing other areas of opportunity in the broader stock market. With the easing of inflation and an expectation of limited further rate increases, we are expecting bonds to look a lot more attractive than they have been for some time. So you will see us utilizing bonds in the portfolio, and we'll talk about that as we get into our updates on the portfolios and what we're doing there. So I'm going to let Mike talk about some of the indexes and some of the data points that we look at that help sort of guide us in terms of our decision-making on the portfolios.
Thanks, David. We want to take a look at the S&P 500 to see where we are currently at the end of business on the second quarter this year versus historical moves. The market peaked early in January of 2022. Index hit the all-time high, close to 4,800 on the S&P 500, and the forward price to earnings multiple went up to 21.4 times. We experienced a sharp sell-off last year. The market bottomed out on October 12th last year, and the forward price to earnings multiple was down to 15.2 times. Index was around 3577. Since then, we have seen a big move up, led by the large tech names. We are now approaching all-time highs once again, but the forward price earnings multiple once again looks elevated. It's at 19.1 times at the end of the second quarter this year. Value versus growth on the left hand of the slide is really looking at relative valuations for the Russell 1000 growth versus the Russell 1000 value index. When the line is moving up, value is expensive versus growth. When the line is trending down like it is currently, value is looking attractive versus growth. We haven't seen levels like this really going back to the early 2000s. We were a little more weighted towards value earlier this year, and growth stocks continue to move up. But right now, they are tech's looking a little pricey right now. On the right-hand slide, S&P 500 operating leverage by sector. Looking at the impact of operating income from a 1% rise in revenues. In operating income, we're really talking about revenues for the companies. So energy is by far would benefit the most by a 1% rise in revenues, followed by real estate and materials. And those are three areas we currently really like right now. Looking at valuations year to date, I like to look at the center slide. Year-to-date returns, we have large, mid, and small. If you look at the large returns, large cap growth, 29% returns this year versus large value, 5.1% return. We hadn't seen a difference like that going back many years, and we feel like that gap's going to close right now. Value will start to catch up by the end of the year, and growth should slow down. On the right-hand side, we're looking at the current price to earnings multiples versus a 20-year average. And at the bottom of that slide, the large cap growth is trading at a steep premium to its historical averages 144% of its 20-year average. And most areas of the market are trading at a premium to its historical average. Small cap value is trading at a discount to its historical average right now. As David mentioned, the labor market has been really strong recently, and it's been an important reason why we've avoided recession as of right now. One thing I thought was interesting with this slide is at the top right, labor force participation. For workers 25 to 54, they have increasingly participated in the labor force since COVID. Been a great job market right now, and they've seen increases in their pay. But for folks 55 plus, we have started to see a sharp decline in their participation, really going back to COVID. They have left the workforce and have not come back. So that's left a big hole in the labor market that we've been trying to fill here.
Yeah, so we're still feeling the impact of COVID right now in the labor market, and it's showing up in that many people over 55 have decided just to hang it up, to retire, and stop continuing to work in this COVID environment.
The yield curve right now, this is a very important slide, and it drives what we're doing on the bond side of the portfolios. Normally on a yield curve, we're talking about U.S. Treasuries, what you could expect to get paid as you lend money further and further out in the curve. If you loan money long-term, you would expect, of course, to be paid more than a short-term loan. So normally you'll see an upward slope on these yield curves like we saw in the end of 2021. It didn't slope up dramatically. It flattened out, but at least at the front end of the curve, it would slope positively up. We have started to see recently an inverted yield curve, and it's really become dramatic at the end of the second quarter. That's the blue line. You're being paid a really attractive interest rate now to lend money on the short term, 5.5%, 4.5%. You only need to lend 1 to 5 years and really receive some attractive returns. But you're not really being incentivized to lend money long term. 4% if you want to lend money out on a 30-year note, or you could be paid 5.5% for short term. So we've started to move the portfolio closer to that front end to take advantage of these attractive yields, and we don't need to tie money up for the long term.
Yeah, one thing is true about this yield curve inversion. Historically, yield curve inversions have always been a sort of a forerunner of recession. So it's one of the reasons that so many people believe there would be a recession this year. There may still be one at some point because, quite honestly, we've never averted one after an inverted yield curve, and we've had an inverted yield curve for some time.
We always are monitoring valuations very closely, and this slide will show us various asset classes, both U.S. and international. And on the far left-hand side are asset classes that we feel are attractive right now versus a historical average. Anything with a negative number is attractively valued versus historical average. Anything with a positive would be expensive. Further you go on the right-hand side is the more expensive the asset class would be. So on the far right-hand side, the most expensive asset classes on this chart, U.S. large cap stocks, U.S. growth stocks. They are not quite as expensive as they were going back to year-end 2021, but they're still trading pretty elevated. On the far left-hand side, after the sharp sell-off we saw in bonds last year, we're seeing some really nice values both in U.S. Treasuries, U.S. corporate bonds, looking really good deals right now. We also see some good value right now, DM equity, that's just developed markets outside of the U.S., trading pretty attractively here. Emerging market looks good. And municipal bonds, we've seen a big move over the last couple of years from being extremely elevated at the end of 2021 to trading at very reasonable valuations here. So we like munis here. Decent yield right now, and we're getting tax-free income. We always try to keep in mind, too, your timetable, your diversification is very important, and you have to recognize that volatility is part of investing, especially in the stock market. On the left-hand side, we see 1-year returns for stocks in green, bonds in blue, and a 50-50 portfolio in brown. So what should jump out to you here is the volatility you can see in any 1 year, especially in the stock market. What we've seen last year, a big sell-off. You can have big up years like we had in 2019. But even in the bond market, though, in blue, we saw a sharp sell-off last year. It's not uncommon. Fortunately, it doesn't happen that often, but we saw a big sell-off last year. The further you go out, though, and look at these 5-year returns, 10-year rolling returns, 20 years, the volatility lessens dramatically. The chance of downside decreases dramatically, and you can get some really nice returns if you're committed to invest in the long term here.
Yeah, and what's also nice is that over time, the stock market to see over a 20-year period a nice potential return. That's the expectation, and you just have to be able to weather the storms and hang in there. That's why we keep plenty of cash and bonds on hand to cover any kind of income needs so that we can weather the storm and be able to take advantage of that long-term return on the stocks.
Yeah, and I think if you're a less aggressive investor and you want to be 50-50, you'll still achieve good returns over the long term, but you have to know your investing style and stick to the plan and not let any 1 year influence your decisions.
Right. All right, we'll talk about the portfolio a little bit here and give you a little update on what we've done based on all that data you just saw.
So we're talking about changes we made to the portfolio. The actual investments in your account may differ due to your circumstances. In your taxable accounts, we may drift a little bit away from our models to limit your capital gains. And additionally, some of you have do not buy or do not sell restrictions in your account. So you may have a slight difference in the models, but we try to get you as close as we can to the models as possible. So we have two main models. We've made a change this year and developed the strategic ETF models. We're using low-cost ETFs. You're basically going to get what the market gives you. We try to keep the costs extremely low. And we also have our traditional tactical stock models where you're seeing full stock and bond model with some funds added to try to take advantage of sectors that we're positive on. So on the strategic ETF side, we did rebalance all the portfolios a couple of weeks ago, midsummer, as part of our quarterly rebalance. And on the ETFs, we slightly increased the small cap stocks, slightly decreased the mid cap, just to get closer in line to the benchmark. And on the fixed income side, we wanted to take advantage of the inverted yield curve we were just discussing, which offers shorter yields on bonds with shorter durations. So we moved some money from the U.S. aggregate bond index, and we moved it to a fund that invests in corporate bonds from 1 to 5 year time period.
Okay, on the tactical side?
In our traditional stock and bond model, we have shifted back towards neutral growth versus value, but we remain overweight value relative to the S&P 500. The S&P 500 is heavily weighted towards those tech names. The big names like Microsoft and Google have a large weighting there. We've added international growth, and U.S. mid-cap growth we think offers a better value at the moment than U.S. large-cap growth. And U.S. large-cap growth seems extended given the current interest rate environment where, unlike a few years ago, you are being paid in the bond market. Folks aren't being pushed too much into the stock market. We still like in the industrial sector. We've been successful recently with an industrial fund, but we swapped out industrial funds for a more focused play on the theme of reshoring U.S. production. We're trying to take advantage of some of the recent bills have passed where manufacturers coming back to the U.S., we're building chips. We're trying to rebuild the infrastructure, bridges, roads, airports that are in desperate need of repair right now. And we've also added a technology sector to partially offset our underweight exposure to technology stocks. And we're overweight right now in energy, industrial, real estate, and materials. Real estate's been a nice play for us. We've been successful on the home building side. We still feel the U.S. Has really underbuilt over the last 10 years. We were underbuilt coming out of the 08-09 crisis, and millennials are looking to buy houses. And recently what we've seen is folks that are enjoying interest rates that are locked in, they're very reluctant to sell their homes and take on a larger mortgage. So there's even less inventory out there. Home buildings become more and more important. There are other attractive areas of real estate, in our opinion, such as warehousing and self-storage units right now. And we have an underweight right now in technology and communications. We do have some of those stocks, but we're relatively underweight versus the S&P 500.
All right, please email any questions you may have to team@rvawm.com. That's team@rvawm.com, and we will get back to you with answers as soon as possible. We appreciate your confidence in us. We appreciate your time today, and we hope that this was beneficial in helping you understand the current markets and what we're doing here for you at RVA Wealth Management. Take care.